Most people assume someone must be winning in a housing crisis. If buyers are losing, then someone else must be benefiting. But what if that assumption is wrong? What if this crisis doesn't create winners, it just redistributes power, risk, and control? And what if the people most often blamed aren't actually the ones gaining the most? The myth of winners in a broken market. When housing becomes unaffordable, the instinctive reaction is to assume that someone must be winning. If first-time buyers are locked out and rents keep rising, the story feels obvious. Homeowners win, investors win, and everyone else loses. But that framing misunderstands what kind of market this actually is. This isn't a zero-sum housing crisis where value cleanly shifts from one group to another. It's a negative-sum market, one where value is increasingly trapped rather than created. Prices are high, but liquidity is low. Transactions are down. Mobility is constrained. And the benefits that appear on paper often can't be converted into real economic freedom. For many existing homeowners, rising prices don't translate into meaningful gains. Their equity is illiquid. Selling means giving up a historically low mortgage rate and re-entering the market at far higher monthly costs. Moving closer to work, downsizing, or relocating for opportunity often becomes financially irrational. What looks like wealth is really a form of protection, insulation from loss, not access to upside. At the same time, the groups most commonly labeled as winners aren't thriving because the system is healthy. They're benefiting because the system is rigid. In a market where supply doesn't respond, turnover collapses, and entry is restricted, advantage flows not to those who create the most value, but to those who already occupy scarce positions. Timing matters more than productivity. Holding matters more than building. That's why focusing on prices alone misses the point. High prices in a frozen market don't signal strength, they signal exclusion. They tell us that demand is being rationed not by income, but by access. Access to capital, access to credit terms that no longer exist, and access to ownership paths that have quietly narrowed. So before pointing fingers at specific groups, we need to ask a harder question. If homeowners are stuck, buyers are shut out, and mobility is collapsing, then who is actually gaining power from this arrangement? And what does that reveal about how the housing system now works? In the next chapter, we'll examine the group most often blamed for this crisis, institutional investors, and separate what they truly control from what the system has handed them by default. Institutional investors, villains or convenient scapegoat? Institutional investors have become the most visible villains in the modern housing debate. Private equity firms, Wall Street landlords, corporate buyers with spreadsheets instead of families. The story is simple and emotionally powerful. Big money showed up. They bought the homes. Regular people were priced out. But simple stories are rarely accurate, especially in complex markets. Investor activity did surge after 2010. In the aftermath of the global financial crisis, the housing market was flooded with distressed inventory. Foreclosures were everywhere. Prices were depressed. Credit for households was tight. Institutional capital didn't create those conditions, it exploited them. Large investors stepped into a vacuum left by households that either couldn't qualify for mortgages or were too traumatized to buy again. In many markets, they weren't competing against first-time buyers, they were competing against empty homes. By the mid-2010s, institutional buyers accounted for 20 to 30% of purchases in certain metro areas, especially in the Sun Belt. That sounds alarming. Until you ask the more important question, what was happening to supply at the same time? New construction never recovered to pre-2008 levels. Zoning restrictions tightened. Local opposition to density intensified, labor shortages emerged, and financing for smaller builders dried up. So investor demand rose into a market that was already structurally constrained. That distinction matters. If institutional investors were the primary force driving prices, then when they pulled back, prices should have fallen. But since 2022, institutional purchases have declined sharply, even as affordability worsened. Prices didn't collapse. Inventory didn't surge. Access didn't improve. That tells us the system was already broken before investors became the headline. Nationally, institutional investors own only a small share of total housing stock, typically in the low single digits. Their influence is real in certain neighborhoods, but insufficient to explain a nationwide affordability crisis on its own. So why do they appear to be winning? Because they operate differently. Institutional investors don't need geographic mobility.
They don't need to sell to upgrade. They don't delay life decisions waiting for rates to fall. They can hold assets through cycles. They can refinance opportunistically. They can accept lower yields today in exchange for long-term scarcity tomorrow. In a frozen market, patience is power. Households, by contrast, face hard constraints. They age. They relocate for work. They form families. They can't wait indefinitely. When housing stops functioning as a flexible good and becomes a locked asset, capital naturally gains the advantage. This is where the scapegoat narrative becomes dangerous. Blaming institutional investors implies that removing them would fix the problem. But even in markets where investor participation has dropped, affordability hasn't returned. Because the real constraint isn't who's buying, it's how few homes are available and how rarely they change hands. Investors didn't design that system, policy did. And by focusing public anger on institutional buyers, we avoid confronting the deeper, more uncomfortable truth. The housing market no longer prioritizes shelter. It prioritizes asset preservation. And any actor, corporate or individual, who can operate within that framework will benefit. In the next chapter, we'll examine what happens when ownership stops being the default outcome and renting becomes a permanent condition rather than a transitional phase.
The rise of the rent economy. For most of modern American history, renting was transitional. You rented before you bought. You rented while you saved. You rented on the way to ownership. That assumption is now quietly breaking. Today, renting is no longer a phase. For a growing share of households, it's becoming the end state. This shift isn't happening because Americans suddenly prefer renting. Survey after survey shows the opposite. Homeownership is still strongly desired. What's changed is not preference, it's feasibility. When home prices decouple from income growth, renting becomes the only option left. Not because it's cheaper in the long run, but because it's the only monthly payment people can clear today. That's how the rent economy forms. At first, it looks temporary. People wait for prices to fall. They wait for rates to come down. They wait for the correction. But as time passes, something structural happens. Households age while renting. Families form while renting. Children grow up in rental housing that was never designed for permanence. The market adapts to that reality. Single-family rentals expand. Build-to-rent communities replace entry-level ownership housing. Leases get longer. Fees get more complex. Rules get tighter. The system begins to optimize for renters who will never leave. This is where the rent economy stops being neutral. Renting doesn't just extract monthly cash flow, it reshapes financial outcomes over a lifetime. Homeownership historically served three economic functions at once: shelter, forced savings, inflation protection. Renting offers only the first, and often at rising cost. When housing costs inflate, homeowners benefit. Their fixed payments get cheaper in real terms. Renters experience the opposite. Rents reset upward, again and again, year after year. Over decades, that difference compounds, not just in net worth, but in resilience. Homeowners can borrow against equity. They can weather income shocks. They can relocate by selling. Renters absorb price increases passively. They carry no asset. They build no buffer. This is why the rent economy is not just about housing. It's about risk transfer. Risk moves from institutions to households, from balance sheets to paychecks. And the longer renting becomes permanent, the more normalized that transfer becomes. Policy plays a critical role here. Tax advantages favor owners. Zoning favors scarcity. Mortgage structures favor incumbents. But rental policy focuses almost entirely on short-term affordability, not long-term security. Rent control debates, tenant protections, subsidies.
These policies may slow displacement at the margin, but they don't create exits. They stabilize people inside the rent economy without offering a path out of it. And once enough households are locked into renting, the political calculus shifts. Owners vote to protect asset values. Renters vote to cap increases. Neither group has strong incentives to expand supply aggressively. So the system settles into a fragile equilibrium, stable on the surface, but deeply unequal beneath it. This is why the rent economy is self-reinforcing. High prices push people into renting. Permanent renting reduces pressure to expand ownership supply. Limited supply keeps prices high. That loop doesn't require conspiracy, just inertia. And it raises a difficult question. If renting is no longer temporary, what replaces the economic role homeownership once played? Because without an alternative mechanism for wealth building, stability, and inflation protection, the rent economy doesn't just change where people live, it changes who gets to build a future. In the next chapter, we'll look at the final group often overlooked in this debate, the policy winners, and why many of the rules shaping today's housing market persist precisely because they benefit those already inside it. Policy winners. Why the system doesn't break. Every housing crisis creates losers, but the reason this one persists is simple. It also creates winners. Not in obvious ways, not through dramatic bailouts or emergency programs, but through quiet, structural advantages baked into policy. Start with homeowners who already own. The U.S. housing system heavily rewards incumbency. Mortgage interest deductions, capital gains exclusions, property tax protections. These policies weren't designed to create a crisis. They were designed to stabilize households. But stability becomes distortion when entry is blocked. Once prices rise and turnover collapses, these benefits stop being neutral. They amplify inequality between those inside the system and those locked out. And politically, that matters. Homeowners vote at higher rates. They're more likely to oppose new development. They're more sensitive to price declines than affordability concerns. So policy responds accordingly. Zoning remains restrictive. Density is limited. Local opposition delays or kills new projects. Even when governments claim to support affordability, the incentives rarely align, because lowering prices means reducing the value of the largest asset most voters own. That's not a trade politicians rush to make. Now consider the financial system. Banks don't need housing to be affordable. They need it to be predictable. Long-term fixed-rate mortgages work best in a low-turnover environment. Stable payments, stable cash flows, minimal forced selling. A frozen market reduces risk for lenders,
even if it reduces mobility for households. Insurance companies, servicers, and investors benefit from duration, not access. And then there's government itself. Housing affordability crises generate pressure, but crashes generate panic. From a policy perspective, slow dysfunction is easier to manage than fast collapse. Rising rents can be subsidized. First-time buyers can be offered credits. Programs can be announced without changing the core structure. These interventions treat symptoms, not causes. And crucially, they avoid one outcome at all costs: price declines. Because once prices fall meaningfully, balance sheets crack, defaults rise, local tax bases shrink, political blame accelerates. So the system learns. It learns how to stay expensive without breaking, how to remain inaccessible without collapsing. That's the uncomfortable truth. This housing crisis is not failing because policymakers don't understand it. It's persisting because the costs are diffuse and the benefits are concentrated. Those who benefit are organized. Those who lose are fragmented. And that imbalance keeps the rules in place. The result is a market that appears stable, but only because it no longer moves. No reset, no clearing, no relief valve. Just a slow narrowing of who gets to participate. In the final chapter, we'll bring all of this together and confront the hardest question of all. If this system works for enough powerful stakeholders, what would it actually take to change it? And why are most real solutions politically impossible?
Why fixing this system is politically impossible. By now, the housing crisis doesn't look broken. It looks stabilized, not because it's fair, but because it works well enough for the people who matter most. The solutions are not hard to identify. They're hard to survive politically. Housing only becomes affordable again in one way. Prices have to fall relative to incomes. There is no alternate path, no mortgage innovation, no subsidy large enough to change that math. And that's exactly the problem. For most American households, housing is not just shelter. It's their largest asset, their retirement plan, their sense of security. Policies that lower prices don't sound like reform. They sound like loss. So even leaders who understand the crisis face a wall. Support affordability too aggressively and you alienate homeowners. Protect homeowners and affordability slips further away. That tension freezes policy in place. Local politics make it worse. Zoning decisions happen city by city, block by block, meeting by meeting. Homeowners show up. Renters rarely do. Density gets framed as risk. New supply gets framed as threat. Delay becomes the default outcome. At the national level, the incentives don't improve. Federal programs focus on demand, credits, grants, down payment assistance. These help buyers compete, not buy cheaper.
When you subsidize demand in a supply-constrained market, prices rise. That's not theory, that's history. So policymakers choose the path of least resistance. They manage the symptoms, they avoid the causes. Because a slow crisis can be explained. A fast correction creates panic, and panic ends careers. There's also a timing problem no one likes to admit. The benefits of real reform come later. The political costs come immediately. A rezoning vote angers neighbors today. New housing shows up years from now, after the election. That gap kills momentum. So the system adapts in a different way. Instead of fixing housing, it stretches it. Longer mortgages, higher debt loads, permanent renting framed as flexibility. Affordability doesn't improve, access just gets postponed. And the longer this continues, the harder reversal becomes. More owners become locked in. More renters normalize renting forever.
more capital reorganizes around scarcity. At some point, the crisis stops being an emergency. It becomes infrastructure. That's why this moment feels so frustrating, not because no one sees the problem, but because solving it would require a level of political coordination and sacrifice that the system is not designed to deliver. In the final chapter, we'll step back and answer the question that ties everything together. If this crisis benefits institutions, incumbents, and policymakers in different ways, who actually pays the long-term cost? And what does that mean for anyone still trying to enter the market?
The real cost of a locked market. The housing crisis is usually discussed in numbers, prices, rates, inventory. But the real cost isn't financial first. It's structural. When a housing market locks in place, it stops doing what housing is supposed to do. It stops reallocating people to opportunity. It stops absorbing population change. It stops adjusting to economic reality. And that failure compounds quietly. People stay where they are, not because it's optimal, but because moving is too expensive. Better jobs go unfilled. Wages diverge by region. Local labor shortages become permanent. This isn't just a housing issue. It's an efficiency loss across the entire economy. At the household level, the damage is slower but deeper. You delay buying, then you delay moving, then you delay forming a family, not by choice, by constraint. Over time, those delays stack. Household formation slows. Birth rates fall. Communities age unevenly. None of this shows up as a crisis headline. There's no crash, no spike in defaults, no dramatic reset. Just a narrowing of who can plan long-term. And that's the defining feature of this cycle.
In 2008, the system broke fast. Everyone felt it at once. That forced action. This time, the system is breaking slowly, and that makes it easier to ignore. The winners are visible: locked-in homeowners, asset holders, institutions that thrive on stability. The losers are dispersed: first-time buyers, younger households, workers priced out of opportunity. No single group carries enough pain to force change, so the system persists, and the longer it persists, the more it reshapes expectations. People stop asking when housing will become affordable again. They start asking where they can still afford to live, or whether ownership is even realistic. That shift matters, because when access disappears, trust follows. Trust in the market, trust in policy, trust that effort leads to stability. And once that trust erodes, rebuilding it is far harder than fixing prices. This is why the housing crisis isn't just about homes. It's about whether the economy still converts work into security, whether mobility is still real, whether the American housing system still functions as a ladder or only as a gate. And that's the uncomfortable conclusion. The market didn't collapse, it locked. And unless something breaks that lock, the cost won't be a crash. It will be a generation that never gets access at all. If this video felt uncomfortable, that's intentional, because housing doesn't usually fail all at once. It fails quietly, by limiting who gets access and who doesn't. In the next video, we'll ask a harder question. Will housing ever become affordable again? Not emotionally, not politically, but mathematically. We'll break down the numbers most discussions avoid: income growth, supply constraints, and why even optimistic scenarios still fall short. If you want to understand where this market is actually headed, not where headlines say it's going, continue with the next video in this series. And if this analysis helped you see the housing crisis differently, consider subscribing. This channel isn't about predictions, it's about structure. Thanks for watching.